Hello friends, welcome back to my channel. So in this video I will explain the benefit of investing in mutual funds through the systematic withdrawal plan route and what kind of returns are possible in if we are actually investing in a lump sum route and withdraw systematically over a period of 10 years. So I have taken the example of two existing funds. One is Kotak Focused Fund. So the Kotak Focused Fund is a fund that has actually launched in 2019. So it is currently having an NAV of 26.94. That is actually having a CAGR of over 15%. So the current CAGR return is 15.44. It was actually launched in 2019 at 10 NAV of 10. Now it is having a NAV of 26.94. So it has given a CAGR return of 15.44%. So if you're actually assuming that a person is actually invested in that fund in 2019, so suppose a total total investment is made. Suppose 20% or a total 20% are actually investing. So suppose 30% or the total amount of 20,000 rupees is put by 30%, and the total investment amount is 6.8 lakhs, or suppose a lump sum investment of 6.8 lakhs is put. The total units that will be allotted at that time of NAV of 10 rupees in 2019 was 68,000 units, and assuming that the NAV actually grow to 26.60 in 2026, the annualized growth rate is around 15%. So like that I actually computed the NAV of each year. 2020 the NAV will be 11.5, 21 it is 13.23, like that. So suppose that person is actually withdrawing 10,000 rupees, 1 lakh rupees every year from 2020 onwards, or that suppose it's actually a group of investors actually withdrawing 1 lakh every year from 2020 onwards. So they will be withdrawing 1 lakh every year for the next 10 years. So total withdrawal will be 10 lakh, and the total units that they will be directed based on the average NAV of 11.5 for the first year will be 8,695 units will be withdrawn. It will reduce as the NAV of the fund rises, and the last year the total units based on the average NAV of 40 will be only 2471 units will be directed, and the total units directed over a period of 10 years for that SWP withdrawal is only 50,187. So even though he has actually accumulated 68,000 units, so the balance that will be available will be the difference of these values, that is 68,000 minus 50,187. So will be still be available. The fund will actually have the balance will actually still have 17,812 units, and based on the value of the NAV of 40 of in expected NAV of 40 in 2029, the balance value will be 6,50,000 rupees. So even after he is actually withdrawing only 6,80,000 rupees, he is withdrawn 10 lakh over a period of 10 years. Still he is actually have a balance of almost the invested amount, that is around 6.5 lakhs. So that is the power of the SWP. That is the power of lump sum investment combined with SWP. And suppose if you are actually assuming that he is actually getting some capital gains, and actually suppose the capital gains, because every investment is taxed based on the initial investment of NAV of 10 rupees. For example, for the first year he is actually withdrawn 8,695 units. So the capital gains will be the difference between the NAV average NAV of 2020 and 2019, that is 1.5 into the units, that is around 13,000 rupees. So like that I actually calculated for the second year it will be 13.23 minus 10 into the units. So the total capital gains will be around 24,000 second year. Last year it will be around 75,000. So the total tax on that amount would be 12.5%. So that is for the first year it will be 1,630. So the total capital gains will be around 62,265 over a period of 10 years. So even if you reduce that amount, the total value that will be available is still 6.5 lakhs. So here the initial investment that is actually made in that particular fund will be available for him even after he is actually withdrawn 10 lakh in that fund, almost available. So you will not be having like the full amount of the investment, but still even after withdrawing 10 lakhs you will still have around 6.5 lakhs of value in that particular fund. So that is the power of lump sum with SWP. And if you take another fund, for example Invesco Focused Fund, so it's actually this fund that actually came with NAV in 2020 at 10 rupees. Now it's actually having an NAV of 25.5. Annualized return is 18.94%. So if you assume that a person invested in that fund in 2020, the total units will be 6.8 lakhs. Suppose he is investing, the total units will be 68,000, and he is withdrawing 1 lakh every year. So at the end of 2026, the current NAV is 25.65. So he is withdrawing 8,457 units in the 2021. Like that, at the end of 2030, he will be withdrawing a total of 48,565 units. And the capital gains for the first year would be the difference of 11.7 minus 10, that is 14,529 is the capital gains for the units of 8447. 11.7 minus 10 into units, that is 14,529. The tax will be 1,816 for the first year, 12.5% of this amount. So like that, the total capital gains will be around 5 lakhs, and the total capital gain tax will be 12% of that, around 66,767 over a period of 10 years. So like that, if you actually withdrawing 46,586 over a period of 10 years by withdrawing 1 lakh every year, so the balance units will be available will be around 68,000 minus 46,000. So you will still have a balance of 21,286, 21,413, and the balance value at the NAV of 48 expected in 2030 is, after reduction in capital gains tax, would be still be 9 lakh 61,000. So he is actually withdrawing 10 lakh over a period of 10 years. So in this particular fund, in 2030, the balance value still expected to be 9.6 lakhs. So this fund is expected to give higher returns as compared to, because it is actually given an annual return of 18%. And suppose if that in this particular fund an investor is investing from now onwards, suppose he is actually investing in lump sum route, he is actually collected a amount of say 6.8 lakhs, or he is actually investing, one person investing or a group of people are investing 6.8 lakhs. So they will be accumulating 26,666 units initially, and suppose from 2027 onwards they are actually withdrawing for the next 10 years. So they are actually withdrawing 1 lakh in the first year, so that the average NAV would be around, assuming that I am actually returning instead of 15%, I am actually assuming only 12% annualized return. So the average NAV will be 28.56 only. The units will be 3,000 deducted would be 3,501 for the year. So the capital gains tax would be the difference between 28.56 minus 25.5 into the units. So that will be around 10,000 rupees in the first year. Like that, actually withdrawing 1 lakh every year. So the total withdrawal would be 10 lakh over a period of 10 years, and the units that will be deducted is 22,157. And the capital gains tax would be 4 lakh 34,000, and the capital gains total capital gains will be around 4 lakh 34,000. It will be the highest in the last year, so around 67,000 will be the capital gains in the final year, because the units deducted is 1264, but the difference in NAV is 79 minus 25.5. So the capital gains tax in the last year would be around 8,475. The total capital gains tax over a period of 10 years will be 54,732. Balance unit he is actually will be actually having at the end of 10 years would be around 26,686 minus 22,157. That is around 4,508 units. And the balance regarding the calculation for this particular investment. So assuming that the NAV would be around 79 at the end of 2036. So the total units that will be withdrawn over a period of 10 years would be 22,157, and the balance units would be the difference between the initial investment units, 26,000 accumulated units, that is 26,066 minus 22,157, it is around 4,508 units, and the balance value would be the difference around it will be around after deducting the capital gains, the balance would be still around 3 lakh rupees. So for example, we are actually investing only 6 lakh rupees, 6.8 lakh rupees, and we are actually withdrawing 10 lakh rupees over a period of 10 years. Still we will actually have a surplus of around 3 lakh rupees at the end of 10 years. So this combination of lump sum and SWP is actually very rewarding for investors who are actually wants to accumulate some fund for their long term needs. Let us assume that in the above case, I actually assume that only 12% returns are actually given every year. So I am actually assuming an NAV of 28.56 in 2027 and 31.99, that is a 12% increase every year. But this fund has actually already given 18% annualized return in the previous from NAV inception. So even if we assume 15% return, I'm actually assuming that if it is actually growing 15% annualized, so then the NAV in 2027 is expected to be 29.3, 28 it will be 33.72. So if we are actually withdrawing 1 lakh every year from this fund from 2027 onwards, so the total units that is will be deducted based on the withdrawal will be lower, because the NAV is actually growing at 15% annually. So the total withdrawal after 10 years would be 10 lakh, and the total unit that will be withdrawn is only 19,681 after 10 years, because the NAV is actually grown much faster rate, because the total unit that will be deducted from the fund will be lower. So the capital gains for that amount would be higher. So that will be around in the first year it will be 13,000, that is a difference of 29 minus 25.5 into number of units. 13,000 in the first year, 24,085 in the second year, like that it will be 75,281 in the last year, as compared to 67,000 when the return was 12%. So the total capital gains tax will be 12.5% of the amount. Over a period of 10 years it will be around, total will be around 62,265. It will be around 1630 in the first year, 3,048 in the second year, like that. So the balance unit that will be available is around 6,985 after deducting 19 total units, 19,681 from the initially accumulated units, that's 26,666. So the balance value even after deducting the capital gains will be still be around 6.5 lakhs. That is the final NAV will be 103. So we are actually accumulating the balance units into the final NAV minus the capital gains tax. He will still have a value of around 6.5 lakhs. So the initial investment that is made on 2.8 lakhs will still be almost be available even after withdrawing 1 lakh every year. That is, even after withdrawing 10 lakh for a period of 10 years, he will actually still have almost a similar investment that initial investment he made. That is the power of lump sum and SWP. So if you are actually investing in a lump sum route and withdrawing, even after withdrawing 1 lakh over a period of 10 years, we are able to accumulate a good surplus at the end of 10 years.